Okay, so this is the final new unit you're going to be starting, Unit 5, which is Business Accounting. So if you make sure your phones and everything are away, you've got pen and paper to hand. I will be giving you some handouts as we go along, but it is important that you do take some notes. Now we've done a lot of quite creative units in terms of you've got visual merchandising and events, we've looked at marketing. This is a unit that you are going to need to kind of think back to your maths, you are going to need to use your maths, you are going to be creating financial accounts. So those, if I say for example a profit and loss account, a balance sheet, maybe a cash flow forecast, that might create a picture in some people's minds. If not, it doesn't matter. But what this unit will be is looking at how do we actually go about creating those accounts. But it's not just that. We need to take a step back from the accounts themselves before we start to create them, because you need to know the finance terms that make up accounting. So what you've got here, these are the 4 main learning outcomes from the unit. What we're going to look at today is the purpose of accounting and maybe how you categorise income and expenditure, but more along the lines of, well, what is a cost? Hoping you've probably got a fair idea of how to define costs, but there are different types of costs. You probably could define revenue, but do you know the formula for revenue? What different types of revenue are there? So that's what we're going to go through today, but then moving on to actually using those terminologies to be able to create a cash flow forecast, a profit and loss and a balance sheet. And the whole point of accounting is not just creating these financial documents, it's being able to say, well, what does this actually mean? Did you look at ratios with Alec?
Yeah.
You did the financial ratios, but you looked at them quite quickly.
Very quickly, yeah.
Very quickly. Yeah. And so, for example, if I said we've got a current ratio of 1 to 1.5, is that good? Is it bad?
That's good, isn't it, the 1?
But do you remember what the ratio means? And
current assets, current liabilities.
So some of these words, so you have current assets, current liabilities, some of these words you've heard before.
What's the unit called, sorry? This
Business accounting.
Okay.
Okay, business accounting. So don't worry because I know the business resources unit, it kind of touches on a lot of things, but do you find it's quite quick? There's a lot to come with business resources, isn't there? It starts off with looking at you as a person, your CV. Then it jumps on to different human resources and technological resources. Then it looks a bit of finance. Then there's a bit of, and it jumps around quite a lot. So what this unit will do will really consolidate your knowledge of business accounting and enable you to be able to create some financial accounts.
And it's P1, sorry?
This will start at P1 and move through.
Oh,
Unit 5. Okay, so what I want you to try and think about is, we're going to talk about all different types of accounts, but you need to think about, well, why do we actually create accounts? So what's the point?
Budgets, targets.
Okay.
Can I put some paper off anyone, please? Just a little bit of scrap.
Okay, we'll come back to targets in a sec. Why do we create accounts, Jay? Why do we create accounts? What's the point in having accounts for a business?
Because you see, it lets you see how well you're doing on paper rather than it lets you know where you are.
How much you spend? Monitor performance.
What was that on, Deepa?
It tells you how much you've got to spend.
So yes, a budget's your kind of your limits, isn't it? What else? Why are we creating accounts?
Because it shows like the business is doing badly or not, and what they could do, they could like invest their money if they've got profits, whether they decide to cut down on their expenses.
So we've got quite a few things there. So we've got, what is a budget then?
The amount of money you have to spend.
So that would be your business budget, would be the amount of money the business has to spend. But then you'd have department budgets, wouldn't you, first of all? So you know your marketing, your HR would all have their individual budgets. But how do we know how much to give them? You think one of the big things about accounting is, well, you can see how you progressed, can't you? You can see, well, last year we had this, this and this was this ratio, but this year it's changed. So it's about monitoring, isn't it? mentioned targets.
Yeah.
In terms of what kind of, why did you say that?
Well, like you've got, if you don't hit your sales target, and like, well, you already set targets, and so you set targets to achieve like a certain amount of sales, and you don't hit those like sales targets, obviously business is doing badly. And then like if they do hit them, they've got a chance to like either expand the business, if they've got like extra money, they could even invest that, give it shareholders can put more money in.
What's the name for the reward that we give to shareholders? Someone over this side. What's the name, beginning with D, the reward that we give to shareholders for investing in the business? Yeah. Okay, so we've got quite a few points there. That sums the majority of it up there. You need to record every transaction you make. Because, well, why? Well, you need to pay either VAT, you need to pay your corporation tax, you need to record every transaction, so you've got a log of it. So you know what's coming into the business and what money's going out of the business. You're monitoring what's happening, aren't you? Because we've talked about before that you can make a loss in the short term, but in the long run, you need to really make a profit, because otherwise how can you possibly exist? If I was going to a bank to ask for money, do you think they just, for a better business loan, do you think they just give it to me?
No, they need to see that that's actual evidence of like they need to see that.
They definitely need to see a business plan, but in terms of finance, what do you think they might need to see?
Like your previous banking and stuff.
So your previous accounts, but they'd also probably want to see your future kind of projections, won't they, your future forecasts. So it's really important that you create these so that if you are looking for future investment, that could be from shareholders as well. Because shareholders will see your accounts. If they see the accounts and they can look at them and say, well, this business is doing well, can only do better, well, let's invest some money in them because I know my dividend payments would be great. But if they look at the accounts, or there's no accounts, there's a sole trader maybe, then how can you make a judgment to invest? Look at business plans, we look at marketing plans. They can be quite, they are objective based, but they're not definite. Finance is definite. It's maths, isn't it? Maths is either right or wrong. The same with finance. When we look at balance sheets, they must balance. Profit and loss, there's no kind of wiggle room, it's either that or not. And what I've put here, control, so that you know at any given time how much money is in your bank. If you're projecting to the future, you can start to think, but okay, in what month will my costs be higher? If I'm going to have to pay a huge amount of money in August, well, do I have to organise some extra investment? Do I have to organise a bank loan for that month? It allows you to plan. Okay, that's the key bit there. As a manager, you need to be able to plan. Thinking about the functions of a manager, linking it back to information systems. You need to be able to plan, don't you? You need to be able to monitor, you need to be able to plan. And you need to know how well you're doing. So that if you are going to give people bonuses, if you are going to expand, if you are going to grow, well then how do you know how well you've done? Do you think of the bankers getting their bonuses? They're getting their bonuses because although they've done A, B and C, they're still meeting their targets, they're still increasing what they had from the previous year. And it's looking at accounts. It's looking at your profit and loss, your balance sheet and your cash flow forecast. That gives you an introduction into accounting. What we now need to do is kind of go back quite a few stages, because we need to understand the different types of costs. We need to understand the different types of revenue. So what I would like you to do, just a couple of minutes, just either in pairs, in pairs would be fine, or in three there, is just pick one of these and just list as many costs as you think that are associated with anything to do with one of these products. So I don't want to give you too long. I just want you to try and list as many as you can. Just any of the costs. Okay? If you want to work with a bigger group, that's fine. But what I want you to do is just list as many costs as you can think of. So which one are you going to pick? crisp, okay. So what costs?
So obviously you've got your manufacturing costs, you've got your
Okay, let's take it back a step. Take it back a step. We've done this before, and not everyone else. Okay. Your manufacturing costs, okay, but what are manufacturing costs? That's like a kind of big bubble, isn't it? What would you have to make these crisps? What do you have to spend money on? Quality, but you take to make crisps. You must spend money on something. Materials, what, the potatoes, the plastic in the packaging. Yeah. Okay. What one have you picked? What have you got so far?
Ink, paper printing, employee payroll.
So ink, paper, printing.
Shipping.
Okay. So what's going to make these papers?
Machines.
Labour.
Where is it going to be? Where is it going to be made?
Oh,
At a location, yeah.
the building.
Okay. Okay.
Packaging.
Okay, making paper. Yeah, packaging. Utilities, because you have to pay for the gas and electric.
in the space of
Labour.
Hang on. Location. Rent.
Which product do you? Yeah.
To make it, probably do lots.
Everything to do with. I'm not. You've made it sure, not just making it. Everything.
Transport.
Everything. All the costs. All the costs associated.
They have to pay materials up,
Yeah, of course.
paint, ink.
Yeah, you can be
then,
very specific.
what are you going about over there?
Equipment, 'cause people can leave
Yes,
their own business.
I mean, obviously, this list could be
Yeah, but
pages and pages. That's very specific. Very specific. You got paid people.
Advertising.
Market research.
Right. Good. So you get what if you look at your costs, they're all very focused on once it's made. The direct costs is what we're going to call them. We'll come back to you're focused on the direct costs. What else do businesses spend money on?
Facilities.
Yeah, facilities. Yeah, again, it's quite direct.
Promotion.
Ah, see? Excellent, exactly. Has anyone actually put down promotion or marketing
We
yet?
put advertising.
Advertising, good. Sometimes you start forgetting those ones, isn't it? Because I'll give you a product, you're thinking about the product, not the business as a whole. Okay. You may keep your discussions ongoing, but I'm going to stop you there. I want everyone to make sure they can shout one out. If someone else takes yours, you need to think for another one. Start the battle with you deeper. Cost. Okay. Sophie?
Production.
Okay, break that. So production, yeah. But, okay, delivery. Okay. Adam?
Research and development.
Emma?
Premises.
So what would you have to pay?
Rent.
Jodie?
The ink and the printing and stuff, so manufacturing.
So what would that apply to everyone? That's a different one.
Supplies.
Zoe?
Packaging.
Anyone forget packaging?
No, we got that.
Transport.
So, is that different to delivery?
No.
It could be. Because delivery could be getting the finished product to the customer.
Yeah.
Transport could be, if we call it
Shipping.
Logistics.
Sam?
Furniture.
Pardon?
Furniture. Their employees like a newspaper. It needs like someone to sit down and rate them and like rate them.
Okay, it's very. So,
You need like you have to sit down like and need computers and
Okay.
stuff. They need chairs, desks.
okay,
like
so what can we
pens.
call, what can we call that?
Office
Fixtures and
accessories.
fittings.
Okay, I like that. Office supplies. Perfect.
What? Bills,
Ah, such as,
water.
Yeah, like gas and water.
so gas,
Electricity.
electric, water,
Labour.
no, yeah.
Advertising.
If we keep marketing as kind of the one.
Software.
Yeah, I guess that will be what I'm trying to do is get like a kind of generic list at the moment. The software for that's the iPod, isn't it? So I guess the software would probably come under here. What did you said another one to do with
Promotion.
we have promotion. Didn't you say
Market research. Yeah.
what else? Is there anything else now? Have you got anyone who's got written down just in general? Hiring staff. Yeah. Well, then we've got labour, but actually hiring new staff. Yeah, I guess. That is a cost. Training.
If it's a newspaper, don't they have to have like someone like lawyers and stuff in case they get like sued and stuff? They have to pay out, don't they? Like 'cause newspapers always getting sued.
Yeah, could be. What happens if something goes wrong? Building burns down.
Insurance.
That's quite a long. Is there anything else that's glaringly missing?
Paying for the trademark. I don't know what it's called. The rights of
Brilliant.
copyright. That's what.
Copyright or patents? Anything else that he really should be there? So we've researched it, we've made it, we've got people, machinery. I think that's the majority. So that's a list of all different types of costs within a business. But what you've got to be aware of is they're broken down into different categories. So the categories being fixed or variable. Okay? I'll come on to the definitions of those in a second. What you just need to be aware of though is these equations. Because what's going to happen is everything that you learn in one session will recover again, but will need for the next. It's like a stepping stone accounting. So if you don't remember one bit or you miss one bit, then it's going to be quite hard for the next. Because for example, I might start talking about total costs, and if maybe you don't know how we came to calculate that, it's really then hard for you to understand the next step. All this is saying, okay, total variable costs is your variable costs times by Q. Q is quantity. So when we define the terms, now this is really important. Fixed costs are costs that do not change with output. That last little bit is crucial. Fixed costs are costs that do not change with output. So by that, what I mean is, if I was to produce no products, I would have to pay my fixed cost for the month. If I produce 1 million products, I still have to pay the same fixed costs for the month. So it doesn't matter how many I produce, they stay the same regardless. Okay? So that means that variable costs are the opposite. So variable costs will increase with output, will change with output. So the more I sell, the more my variable costs go up. So is the best one to think about a fixed costs. Because if you've got a factory space, you pay $2,000 a month for this space. But if you decide to not make anything in that month, or you don't sell anything, then that doesn't matter. The person still wants his $2,000 a month rent. If you're the most productive business ever and you make 100,000 products in that month, he can't charge you any more because that's a fixed cost. It doesn't change with output. best way of thinking of variable costs is your raw materials. The materials that you use to produce the product. Because obviously if I'm going to produce one monitor, I need the materials for one monitor. If I need to produce 10 monitors, I need the materials for 10 monitors. So that's where this equation comes in. Your total variable costs are your variable costs per unit, so the cost to produce one, times by how many I'm going to produce. Okay. So remember, fixed costs stay the same regardless of output. Variable costs will change with output. So what I'd like you to do, going back to this one, is if you've got a few to add to your list, add them, and then just next to it, are there a fixed cost or a variable cost? Next to each one of those. Add them. As a group, okay, not just spout it out. Yeah, that's fine. So just, are there fixed costs or variable costs? So just go through them.
Depends what kind of meter you're on. You're on a meter, or
That's variable, isn't it, I suppose?
There are some that are, you could have more around the grey area.
Very one now.
You've got more heat.
All the stuff just to make it like very.
Patent, that's
I would say
fixed.
utilities are variable.
But then the bills would be variable to change.
Machine.
The bills would
No,
be
utilities is variable.
Materials.
I
B.
say it's dead tough. You could argue either one. Because you could say, for example, electricity, well, the more you produce, you need the machinery on for longer. So it's on for longer. Yeah, so I would say they're variable. If I had to pick, I would say variable. But you could argue the case for
They
fixed.
can be fixed.
Some companies might pay a fixed amount each month.
No, because it's a big amount every month.
Depends on the size of the company. I'd
What
say.
market research bits? You'd only pay it once, yeah?
Well, there you go then. You just answer your own question.
Yeah, no, if you're working
That
on
time
it,
of it.
Does it change with output?
No.
Always think of, not will it change, because yeah, of course they're going to change. Your rent might change, might go up next year, but it's with output, yeah, that's the key bit.
Variable. That's
One
the
to
same
say,
bit.
if you're building one monitor, the plastic for one
Yeah,
would
but
be
it's
more
right.
expensive per unit.
Nothing else.
So if you're one
Again,
plastic
more.
for
I don't know, don't you think it's
Okay, your cost, yeah, think of it with output.
It could be
What you're
right.
thinking of what's known as economies
Yeah,
of
but
scale.
it can't change without
So like bulk buying.
Yeah.
The more you buy, the cheaper it becomes. But that's a different concept. What we're getting at is the more you have to make, the more you have to buy. Yeah.
Yeah.
Sure, to be fair. Once you get the wine, you usually don't you focus so long. It can be right.
photographer.
Or copyright, isn't it?
Oh, it's just shipping.
Yeah, copyright and everything.
How do you get on giving your flyers out?
Yeah, but
Yeah,
like,
right.
they're not
Is there a few people receptive?
Yeah, everyone accepts it. Anyone say anything,
I
right?
think we're being intimidated.
Yeah, that's
It's
really
like,
easy.
when you give you a flyer. Well,
Depends how you did it. If you're going to run up to them like this, then they might have been a bit intimidated. But you know,
you just put it in their face or anything.
just wave it in front of them
Oh,
like this. They're eating their food. And you just kind of shove it in
explained
their
it
face.
first, and then said, do you want a flyer?
Yeah.
I explained it
Okay.
first, and I said, would you like a flyer?
That gives them too much. That gives them an option.
But they all took one. They all took one, so... And I got my friend to take some to Farron College.
Yeah, okay.
My mum goes to town, so my mum takes some to her friend.
Just be careful with where they don't. Make sure it's not a mess.
Yeah, we're being up there. Well, when you go to the cafe, what station is it now? Together.
If I'm making one
Yeah,
product,
they'll take it.
how much package do I need? If I'm making two, so that means
It's
it's.
alright, we get finished early. I think it's about half an hour for this.
Yeah.
Stage time, I think.
Okay, right. We'll
No,
start, I'm
we
not going
can
to go through these in order because some of them are a bit more awkward than others. But we'll go through in a kind of logical way. So research and development, Jay.
That'd be fixed.
Well, rent, we all know we've done that one. Okay, we know that one.
Back a bit.
Yeah, sure.
Okay. Machinery, Berthin.
Fixed.
Fixed.
Yeah.
You use it once to make, you buy a whole piece of machinery,
Yeah.
you make one product, you make 1,000 products, yeah? Okay. Packaging, going at the back, explain why it's what you said.
It's variable because the more you make, the more packaging you have to do.
There's no Irish market there.
If you make one, you package it for 1, 2, 3, 4, 3, yeah.
Sorry about that.
Office supplies. Now, if we focus on the furniture rather than the kind of the staples and things, Zoe, office supplies.
Fixed.
Okay. Market research, Sam.
Would it be variable? Or would it be fixed?
Well, it's one of yes, you are right. It's one of the two. Why do you think it's variable?
Because it could change. Like one day, one time I have to do like more than they did before, and you might have to like use different equipment to do it.
Okay.
That's why.
Like you have to pay the staff the same, but
Okay.
you don't have to.
You're right what you're saying, but remember the definition of what makes fixed and variable.
Is it very?
Does it change with output?
No.
Must be
Which
fixed
one's
then.
that? I'm confused.
Must be fixed. Insurance. What do you get for insurance? What do you get for insurance, Adam?
Variable.
Variable.
It can be
Well, the more
both.
products you have, the more you've got to insure.
We're talking business insurance, aren't we? Insuring premises, the insurance. Insuring the premises of the.
Should be fixed.
We wouldn't have insurance, would we?
Courtney,
Oh,
copyright and patents.
Didn't even have it.
Fixed. Okay, I would say they're all the clear-cut ones. So we've missed out a fair few. If we start with, we had a discussion about overheads. So what kind of, do you want to sum up what we were talking about, Emma?
That although you have to pay electric and heating every month, if your hours of working are longer, then it's going to change.
Yeah, we said it's variable.
Yeah, but because of that, because the more you make, the more power you
Yeah,
need.
because if you made only one product, you only need like, I don't know, 10 minutes. But then if you was proper going for it all day making loads, and
Proper going for it. Yeah.
and then it costs more because you've got electricity in you.
No, you're right. If you are proper going for it, then yeah. I suppose it will. Has anyone put fixed though?
Yeah.
Guys, why do you put fixed?
Because you've got the same. What he said is right, but because you pay it every month, but I guess it's not always the
No,
same.
you do pay every month. Some people have a fixed bill, and some people just pay a certain amount each month. So maybe for, I don't know, your phone. Well, we did actually have internet up here, didn't we? Maybe your internet. That might be fixed. Right, this is always a contentious one. Labour. Fixed or variable?
I'd say
variable.
both.
Because you might need more staff when you.
So you said variable.
Depends.
You said depends.
It depends if you make a certain amount. Like if you make a certain amount of products a week, then they know how much labour they need, so they'll be paying the same amount. If they start making more products, they need more people to make it, and they're going to have to pay
Then
more people.
you have a budget for like labour, don't you? Kind of thing. So like.
If I split it down a little bit further,
Yeah, but I thought like.
can we now make a distinction between the two?
Yeah. Salaries you don't get any on top.
Between
It's just a basic amount every month.
So would one of these be fixed and one be variable?
Yeah.
Which
Yeah.
one? Which way round then? You said yeah. Which way round?
Salaries are fixed and wages are variable.
Okay. This is a theoretical approach to it because you per hour you could say make a certain amount of products. So you can attribute this monitor takes 30 minutes to make. So therefore you can do that. You can associate that as a variable cost. Obviously you can't hire people per half an hour. So it's a theoretical approach to this. But with salaries, you are paid £25,000 a year. That's fixed, isn't it? You have your contracts in place, you have to do certain things, but that is what's known as fixed costs. Who mentioned hiring staff and training? Who's
I said training.
is that fixed or variable, can we say?
Variable. Depends. Isn't it?
Depends who trains you.
We'll say some of it's to do with output though.
Yeah. It's a bit confusing.
It's an awkward one. Do you know what? Very rarely does this come up. I would say that in terms of training, it doesn't output's completely separate.
Yeah.
But hiring staff, well, if you make more, you need more staff.
Yeah, that's what I meant.
So
earlier
maybe you could
about
actually
wages.
split these into into 2? Possibly. What about lawyers? So you need to fixed or variable, Jodie? Variable. Why is it variable then?
I think this is the first time I don't know what's there.
If you made 1,000 or you made 1, would it make a difference to maybe that?
Okay. Yeah. I need to think about the output. I don't know.
You see, it's the outputs.
It's
The
the
key to
output.
Is
it.
it because you only need them like when you need
So-
them? Like you won't have them there constantly. You only need them when you're getting food or something, or when something happens, you're going to need them there. You're not going to need them there constantly because there's no point in being there if you don't need them.
Yeah, if it's a big company, it'll be in-house and it'll be fixed. But for any other company, just outsource them.
But it will still be fixed because nothing to do with output, is it? That's the key.
True.
It's that you must remember always link back to output.
Yeah.
Then it might change. I'm not saying that fixed and variable doesn't mean it will never change. It means it won't change the more you produce.
You're 3 times
It's
more
like an
likely to be
average.
sued if you make 3 of a product.
Well, I suppose, but that's no. Right, marketing. This is always a good one. Fixed or variable?
Variable.
But can it be for like different new products that you bring on the market? So each time you do bring a new product to market, product development, then you have to raise your costs.
This is per product. Not, I know you've got if your product range. Yeah, what we think about.
Would you give them like a budget that they have to stick to?
If you make more products, does that mean your marketing costs go up?
Yeah, you've got more stuff to ship, more people to sell it to.
Maybe a
So your
faster
marketing
rate
costs
as well.
go up.
No, only if you make it, only if you choose to make it, do that. If you know what I
You
mean.
need to go to like
If remember outputs how much I'm producing. Okay, so as to meet a demand already there. Okay.
No, you wouldn't have to do advertising because if it's the same product, they already know that.
But if you advertise on one source like a newspaper, then surely if you expanded like Adam said, then you would need to use other avenues, maybe like television. And so wouldn't it?
What you're all saying is right. This is the most awkward one, because marketing will help you to increase your output, not the other way round. Okay. If I'm going to make and sell 1,000 or make and sell 5,000, doesn't change my marketing expenditure.
No.
I change my marketing expenditure to affect my output. It's an awkward one. Okay.
Say that again.
It's an awkward one.
No,
But
before.
No, I mean, no. With marketing, you use marketing to change your output,
Yeah.
but the more output you make doesn't change how much you're spending on marketing. Okay. That's one way of classifying costs. Okay. The other way you need to be aware of, I'm not going to spend too long on this. The other way you need to be aware of is operating and startup. By that I mean that some costs you need to pay every month, every week, every day. Some costs are a one-off cost. This one's a little bit more clear-cut than the fixed and variable, so I'm not going to make you go through every one. But can you just give me a couple of examples of each? What would be what would be a start-up cost? A cost you only pay maybe once at the start or before you even start. Materials.
Furniture.
I was just thinking.
You use furniture.
Trademarks.
What else?
I only said materials then because my sister got a little like tiny little salon, and so she bought like all the hair dye and the products and stuff. They would then last her like a long period of time.
But she have to buy them again.
Eventually, yeah. So
All
materials.
that, yeah.
Okay.
Materials is one of the. If you think of it, every month you need to buy your raw materials. You need to pay your staff. You need to pay your rent. So they're every month. There are some. Jay, on your phone. There are some. So, for example, that you pay at the start. Okay. So just make sure you've got a definition down, so you're clear in your head. Operating, paid monthly, ongoing costs, but your start-up costs are paid at the start of the business.
So was most of the fixed go in there then?
No, they're very
People still do
because
that.
you've got here.
That's variable. Oh, no, that's fixed, isn't it?
Marketing will be there as well.
Okay.
Just think about stuff you pay.
Yeah, alright.
So, example, there are some.
Could machinery be in the middle?
Yeah. There are last some. Because you buy your machinery at the start, you need it to start up, but
some you pay.
odds are you're going to have to buy it again 2-3 years down the
No,
line.
yeah, some you can't afford. They're so expensive. You pay a monthly.
Yeah, but then that would still be classed as start-up costs, and then your repayments would be your operating, your hire purchase or your loan repayments. Okay, so we've got 4 definitions of costs. Fixed, because this is really important. Fixed costs do not change with output. Variable costs change with output. Change, i.e. when more units are produced. Start-up costs, one-off payments at the start of the business or your repayments. Operating costs paid throughout the life of the business. So that's costs. We're all happy with the 4 definitions of costs. There are some ambiguous ones, I know, and marketing is the most awkward one, but as long as you're clear with the definitions, just remember it's output. Always refer, fixed and variable, always think of does it change with output. Right. So we've looked at one side of the business. Now it's the other side. So most people think that businesses only get money in one way. And that would be, I'd have thought, sales. What do you think that, out of interest, what do you think that equation stands for? I'll leave profit to one side for a second. What do you think SP times QS? Think of what revenue is. That's kind of what this is calculating. What do those words? What are those words there? Do you think? What do they stand for?
QS quantity sold.
QS is quantity sold.
Sales percentage or something like that?
No. If I sell this for £5 and I sell 1, how much am I making?
£5.
If I sell 2?
£10.
So what's the missing bit? What's the missing bit here?
I said profit.
£5. Selling price. It's selling price. So simply, there's nothing particularly complicated in this one. It's just your revenue, your total revenue is your selling price, so how much are you selling it for, times by your quantity sold. How many are you selling? It's something that those of you that have sold things in the past will just do naturally. But it's just the equation that backs up that. You know that if you're selling something for 50 quid and you're going to sell 5, well I know I'm making £250. That's obvious maybe, but that's just the equation that, that solidifies that. So that's the main way. What I've given you there is a sheet. If you could just make some notes as we're going through on the definitions of each types of revenue. So your sales revenue is literally your sales revenue is literally the sales made by, or sorry, the revenue made by the sales of a product or service. Okay, so the revenue made by the sales of your product or service. Now, for most businesses, well, for all businesses really, that's going to be your main way of money coming into the business. But what you've got to be aware of is it's not the only way. There are all different types of ways that businesses can get money. And what I've got here is a list. And what I'm going to do is talk through them. And I just want you to just make some brief notes under each in each box, just so you've got a definition for each. Some of them are clear, and some of them not so much. So the other revenue, also known as non-operating revenue, is money that a business makes, but not from its main purpose. So for example, if you've got a business that produces a particular product, they may have some storage space they rent out. They may, you may have a web design company, and at the weekends they do classes. So normally they design websites, but sometimes they do web design classes. It's not their main reason for existence. It's not the main thing that they sell, but it's still a service that they're offering, or something they're offering, which brings money into the business. So you can think, it could be absolutely anything. I mean, storage space class is the ones that spring to mind for me, but it could be anything. Just anything that's not their main reason for existence. That's the key to that one. What do you think, how can the business get money from the government?
Grants.
Yeah. Grants, small business loans. Think back to P6 from a business environment. You know, you can apply for money from the government. So you've got the unlimited. You could, you know, there's enterprise funds, there's small business loans, there's startup grants, there's ways that businesses, or startup business particularly, can get money coming into business. Thinking back to P5, what are interest rates? Go on.
Me.
Yeah. What are interest rates?
No one to explain it.
There was a sentence, wasn't there? Who remembers the sentence that I always said? Da-da, and a da-da, da-da.
It's basically the money. Don't know how to explain it. It's like basically the charge of what you get from the money you borrowed.
Charge. Okay. Who remembers what I said it was?
Cost of borrowing, the reward of saving.
Exactly, yeah. The reward of saving and the cost of borrowing. So, if my business is going to lend Jodie's business £5,000, I'm not going to do it out of the goodness of my heart. I'm going to want some interest, and that's revenue. So I'm going to get the £5,000 back, but I'm probably going to get, I don't know, whatever the interest rate I'm charging is, I'm going to get some extra back. So any money I loan as a business, I will get interest payments back to me, and that is revenue. Money coming into the business. So it could be from any business you've lent money to, but it's money coming back into the business in the form of interest. The next one's dividends. We all said that dividends were rewards to shareholders for investing in a business. Businesses can invest in businesses. There's nothing wrong with that. So if we have some retained profits, some spare money, and we don't feel it's the right time to expand, we don't really want to look to move to another country, not just yet with the exchange rate's not just right. What should we do with the money? Banks, well, interest rates are pretty bad at the moment. There's no point saving it. How can we make the most of this money? Let's invest in shares in that business. So then once a year, I will get my dividend payments. Just like an individual would for investing in a company, I get my dividend payments, my dividend revenue. The final one, royalties. So what are royalties? You probably would have thought you've heard of the term before. Can anyone define it?
Is that like, say, with Beyonce, every time a song comes on the radio, she'll get royalties for that?
Yeah.
Yeah.
So like, yeah.
Continuous.
Yeah, on Radio 1 they get like £36 a song, something stupid like that, or £16 a song.
What's that?
Radio 1, when they have to pay, I think it's either 16 or 36.
It'll be a bit more. I thought it'd be a fair bit more than that, but you are right. So it's
Like merchandise and stuff.
it's using someone's name, isn't it? If you're going to use a song, a logo, a name, then you need to pay that company money because you're kind of trading on off them, aren't you? You're getting a benefit from using their name, so why shouldn't they get a reward for that? Why shouldn't they get income for that?
Actually, you know, like James Bond films, they're all like paid for from royalties. They do loads of advertisement, and that's how they get their funding.
It's slightly different with that because James Bond, they're not using the name to benefit them. The other company are paying them. It's good for its product placement. It's like the opposite in a way. Have you got something down for each one of these revenues?
Yeah.
Are you happy with
No, dividends I ain't got anything.
dividends? Remember, it's the reward for investing in another company. So if I'm a business, I can invest in another business and get that dividend payment. Okay? So we've talked about costs, i.e. money leaving the business. Talked about revenue, money coming into the business. So hopefully you're going to be left with a profit. So put in very, very simple terms, profit is obviously when revenue is greater than costs, isn't it? So when there's more money coming into business than there is leaving. So therefore loss must be when your costs are greater than your revenue. Sounds simple. Just make sure that you're happy with what they are. What you have though, and this is really key so especially when we look at the profit and loss accounts, is the different methods of calculating profit and the different classifications of profit. And what you have here is your gross profit and your net profit. I don't know if those terms, I would have thought you've probably heard of the terms before. People talk about net profit, then talk about the gross profit. You might have seen it in the news or what have you. Some people might know what it is straight away. But all it is profit at different levels of the business. So the first thing that you calculate is your gross profit, just as it says here. So it's your sales revenue, all the money coming into your business, minus your cost of sales. And what these are, they're direct costs. So what I mean by direct cost is a cost that you can clearly see has attributed to one product. So for example, your labour, your overheads, your materials. You can see that when looking at this one product, where it took half an hour to make, so therefore it cost this much electricity, it took this much time, so there's this much labour, and there's this much materials. You can see that from one product. That's what's known as your direct cost of production. So when you take away your cost of sales from your revenue, you get what's known as your gross profit. However, this doesn't take into consideration your expenses. So your expenses are your indirect costs. And this is where, when you start to look at creating a budget for a company, it gets really, it's quite awkward. Because how do we know how much, say for example, we spend a certain amount on advertising, how do we incorporate that into the selling price of a product? I mean, we must cover our costs. In the long run, we must cover our costs. So if we're going to spend millions on advertising, how do we then, okay, well, if we're going to, okay, that means that we're going to put an extra 15p on the price of that. How does that happen? Very, very difficult. Very, very difficult. But what you need to know for the moment is their indirect costs. Because you cannot see directly how that cost goes into the selling price of one product. So when you look at your profit and loss account, it's gonna go down, and you're gonna have revenue, cost of sales, gross profit, and then you're going to go down to expenses. It will become clearer when you see it. I've got some example accounts that you will be using today, and when you see these accounts, it should give you a bit of a clearer picture as to what these definitions mean. Okay. Right, so I've gone through this slide. I'm not going to go through it again. The reason I've got it up for is that there is a major part of P1. So for P1, you're going to need to explain why businesses create accounts. What is the point in accounting? Why have we got accountants? So hopefully for you, this should be your reason for existence then.
Yeah.
Okay? But this is what we're looking at, okay? The reasons why we have accounts. If you can log on to the VLE, and on the accounting page, you will have, there'll be a PDF file, and it will be kind of something like example accounts or sample accounts. What you're going to need to do is look at these accounts, and we will have some time to talk through them. But what you'll notice is, especially in the profit and loss account, 2008 wasn't such a good year. 2009 was a much better year. So when you're explaining the purpose of accounting, you just need to be able to refer back to these documents. And I'm not saying you have to be comparing and contrasting a great deal, calculating percentages, what have you, but you need to be able to look at and show how do you use an account to check on the financial performance of a business. So you may look at the profit and loss account and you may say, well, in 2009, the turnover, i.e. the revenue, was much, much higher than in 2008, and that's why they've made a profit. And so what you can do is you can start to look at an account and see, okay, well, why is it better? Why are we doing better this year? So what you've got there is you've got your two questions to make up P1. The majority of it is going to be the main purpose of accounting, which is these bits here. Okay? Second part of it is using these accounts. Now, if you look at the PDF, it is a 20-page document, but you don't need to really go past page 7. So familiarise yourself with the document and just start to crack on with this question. Has anyone got any questions for me before? Is there anything you need me to go over, or you just completely don't get before we start? No?